Since 2019, more than 7,000 bank branches have permanently closed across the United States, yet major financial institutions continue reporting stable profits, rising digital engagement, and surprisingly strong balance sheets. That contradiction should immediately make you pause and think more carefully, because institutions do not usually shrink their physical footprint at the exact same time their financial performance appears stronger than ever. If banks are financially healthier, more efficient, and more technologically advanced than at any previous moment in history, why are the marble buildings, teller counters, and vault rooms that once symbolized stability quietly vanishing from both cities and small towns? The answer is not crisis, and it is not bankruptcy, nor is it some dramatic collapse unfolding behind the scenes. It is a structural transformation that began gradually years ago, accelerated rapidly during global lockdowns, and is now fundamentally reshaping how financial power operates beneath the surface of everyday economic life. For centuries, banks invested heavily in architecture, because architecture was not merely decorative, but a psychological instrument that transformed abstract financial trust into something physically solid and emotionally reassuring. When customers walked beneath high ceilings, polished marble columns, and reinforced vault doors, the sheer weight and permanence of the building itself became part of the promise being offered. The structure communicated endurance and continuity in a world where money felt fragile, economies were unpredictable, and uncertainty was constant. But money no longer lives inside those imposing walls of stone and steel. Today, more than 90% of the global money supply exists as digital ledger entries, stored inside distributed databases that operate far beyond public visibility. Your salary is not stacked in a vault waiting behind a thick metal door. Your savings are not quietly sitting inside a drawer guarded by security cameras. They exist as encrypted numerical records, moving instantly through interconnected systems at the speed of light across global networks. Once that digital reality became dominant, the physical branch slowly shifted from operational necessity to symbolic presence. And symbols, especially large architectural ones, are extraordinarily expensive to maintain. A single traditional branch requires rent or full property ownership, trained full-time staff, layered security systems, regulatory compliance departments, cash logistics, constant maintenance, and regional managerial oversight. Multiply those costs across thousands of physical locations, and the financial burden becomes enormous within an increasingly competitive and technologically driven global market. Now, compare that model with a digital-first bank operating through cloud infrastructure, centralized engineering teams, and automated customer support systems powered by artificial intelligence. Instead of expanding through concrete, steel, and physical real estate, it scales through software updates, server capacity, and data optimization. Instead of hiring hundreds of local employees, it deploys lines of code that can process millions of customer interactions simultaneously without fatigue. The economics of that comparison are not subtle, and they are not evenly balanced. Software scales faster than stone, and it does so with dramatically lower marginal cost. The real turning point, however, was behavioral rather than purely financial or technological. When mobile banking applications became easier, faster, and more intuitive than physically visiting a branch, customers changed their habits quietly and almost without resistance. Deposits could be scanned through a smartphone camera in seconds without waiting in line. Loans could be reviewed and approved within minutes through automated risk models. Investments could be monitored and adjusted with a simple swipe on a screen. During the global lockdowns of 2020 and 2021, physical branches closed temporarily in large numbers, yet the financial system did not collapse or even significantly slow down. Transactions continue to process smoothly through digital rails. Accounts function normally through online dashboards. Payments cleared across global networks without interruption. Executives inside major financial institutions observed something profound and potentially irreversible. Customers adapted almost instantly to a fully digital experience. What had once been considered essential physical infrastructure was suddenly revealed to be optional. From that moment forward, the branch was no longer sacred, no longer untouchable, and no longer strategically indispensable. It became, in corporate terms, a cost center rather than a competitive advantage. Meanwhile, digital-only banks and fintech platforms gained millions of new users, particularly among younger generations who prioritize speed, user interface design, and seamless integration over physical proximity. For many within Generation Z and the younger segment of millennials, a banking relationship begins with an app download notification rather than a handshake across a desk. Trust migrated gradually from architecture and physical presence to interface reliability, system uptime, and user experience consistency. And once trust becomes interface-based, the competitive battlefield shifts entirely from geography to technology. However, this transformation is not merely about efficiency or convenience, and it cannot be reduced to cost-cutting alone. It is also about the redistribution and concentration of financial power. Physical branches distribute banking presence geographically, embedding institutions into local communities and regional economies where relationships once mattered deeply. When branches close, those geographic anchors quietly disappear, especially in rural or lower-income regions where digital access may remain uneven or unreliable. At the same time, digital banking centralizes operational control into fewer technological hubs, concentrating decision-making authority within algorithmic systems. Loan approvals increasingly rely on automated risk engines that analyze behavioral data, transaction histories, and predictive statistical probabilities at scale. Fraud detection systems scan billions of data points in real time, identifying anomalies faster than any human compliance team could ever manage. Credit scoring now incorporate machine learning models that continuously refine their predictions based on new behavioral inputs and adaptive data streams. The institution that once evaluated customers through personal interaction and local familiarity now evaluates them primarily through data interpretation and predictive modeling. This transformation quietly changes the fundamental nature of banking itself. Traditional banks primarily stored and safeguarded capital as their central function. Digital banks process, analyze, and increasingly predict behavior. Spending habits, subscription cycles, repayment timing, geolocation patterns, device fingerprints, and transaction rhythms all contribute to a continuously evolving digital profile. The bank of the future does not merely hold your money securely, it models your financial identity dynamically. When physical buildings disappear from the streets, the system becomes less visible, yet more deeply integrated into daily routines. You do not physically enter the bank anymore. The bank enters your life through push notifications, automated approvals, embedded payment systems, and invisible background algorithms. Invisible infrastructure is powerful precisely because it feels ordinary and unremarkable. From a macroeconomic perspective, this shift allows large institutions with advanced technological capacity to widen their competitive advantage significantly. Smaller regional banks face disproportionately higher costs when attempting to maintain physical branches while simultaneously investing in digital infrastructure upgrades. The likely result is further consolidation within the financial sector, where scale and technological sophistication become decisive strategic factors. At the same time, policymakers increasingly debate issues related to digital identity frameworks, cybersecurity resilience, and the systemic risk of cloud-based financial architecture. When banking becomes software, systemic risk also becomes technological rather than architectural. A branch closure is visible to the community immediately. A server failure is invisible until its effects cascade across interconnected systems. Yet, despite these structural risks, the economic incentives strongly favor continued digital expansion. Customers demand frictionless convenience and instant access. Investors demand efficiency, scalability, and margin expansion. Shareholders demand sustained profitability in competitive markets. The marble building cannot compete with the server rack, no matter how iconic it appears. And so, the disappearance continues quietly and methodically, not through collapse, but through replacement and optimization. Physical banks are not dying because banking itself is fragile. They are fading because the architecture of financial power has fundamentally changed. What once required geographic proximity now requires digital connectivity. What relied on walls and vaults now relies on code and encryption. And when power moves from visible structures to invisible systems, public awareness often lags far behind structural reality. The quiet closure of a local branch may appear to be a minor inconvenience at first glance. In reality, it signals a deeper reorganization of how financial authority is exercised in the digital age. The question is no longer whether branches will continue to close over time. The question is how this invisible infrastructure will shape economic opportunity, access to credit, and financial autonomy in the decades ahead. If financial institutions no longer require physical space to operate effectively, then banking becomes less about geographic place and more about data accumulation. And when data becomes the primary asset, the rules of power subtly but profoundly change. The marble halls may empty over time, the vault doors may slowly rust without use, but the system behind them grows faster, leaner, more predictive, and more deeply embedded in everyday life. That's the silent banking shift unfolding around us, often unnoticed. If the buildings disappear while profits remain strong, then the real transformation is not occurring on the street corner. It is unfolding inside the code that now defines modern finance. When power no longer needs walls, it becomes harder to see clearly.
And when it becomes harder to see, it becomes easier to overlook entirely. If this transition continues at its current pace, what other institutions built on physical presence might quietly transform into invisible digital systems before we fully understand the consequences?